everyone. I'm Nick Brito. I'll be moderator for this panel. And the title of the panel is The Great Stablecoin Divide, Where's the Real Value? So we'll be discussing the current state of stablecoin adoption and some visions for the future. But just to quickly introduce our panelists, so we've got Junaid, co-founder of Stitch Money, which is one of the leading South African payments businesses. We got Sanja, the SVP of Partnerships and Business Development at Circle, one of the largest issuers of stablecoins. We've got Erica, co-founder of Lead Bank, which is a commercial bank in the US that powers a lot of crypto businesses. And Chris, the co-founder of BVNK, who we all know well. I'm sure many people read Patrick and John Collison's annual letter, which was published just a few days ago, but I was reading it on the plane ride over here, and there was a quote that I wanted to open up this session with because I thought it was very apt, which is, "It may be a crypto winter, but it's a stablecoin summer." It particularly hit me coming from London winter to Cape Town summer for this conference. But basically, Bitcoin price has been down more than 40% over the last 6 months, but at the same time, stablecoin volumes have more than doubled. And so the first topic that I wanted to get each panelist's view on is what use cases are really driving that volume and why. Maybe if we start with Chris.
Yeah, for sure. So I think we sat at this, we have a good seat to look at this, and if you look at the data within the 30 billion odd of TPV that we process, there's a couple of use cases. It's kind of split across consumer type use cases, but B2B as well. So we see a lot of B2B payments use cases. There's a lot of B2B flows happening. We also see account funding and withdrawal use cases. So anyone that's got some sort of financial platform looking to fund and withdraw from a global user base that works, stablecoins are well suited for that. Stablecoin checkout, so adding stablecoins as an APM into an actual checkout is starting to pick up across e-com. And then one that we see and has been one of the more exciting use cases for us are marketplace and payroll payouts. So we power payouts for Deal, which we do some of the employee payouts. They're paying out into 80 markets around the world instantly in digital dollars. So it's a good mix and a blend, but overwhelmingly the last few years it's been B2B driving that, but we're starting to see more and more consumer use cases come to the fore.
And what are the main drivers driving that adoption? Like, what are the reasons for those particular use cases?
I think it's two things. We've seen there's two kind of themes. One is stablecoins as a payment method. So this is pay-ins, payouts, PSPs. We work with PSPs like dLocal, Tunes, Visa Direct to add stablecoins to a checkout API or a payouts API. So that's the one thing, and stablecoins are well suited as a global, always-on APM. Alternative payment method. But then what I think is really exciting is what we're starting to see, which is pushing more into stablecoins as financial infrastructure to build new financial products and experiences. And we're seeing that with embedded digital dollar accounts. So these are remittance apps, B2B platforms, adding stablecoins as a core bank account or a core dollar, a dollar bank account to, get some of those same kind of financial primitives. One being, your checking account, your savings account, all are now in one account in this digital dollar account. You can add a card on top of that to spend. So it's that kind of stablecoins as a payment method, but also using this to build new financial products and infrastructure.
Erica?
Yeah, I'd agree with everything that you enumerated there, and I think as we get into further leaning into interoperability between the digital dollar and sort of fiat currency, and you can pay for your coffee out of your stablecoin wallet, you see greater adoption there. You also see, I think, a lot of variance by region. I think in the States, the use case has predominantly been B2B and global remittances and making it faster, cheaper. I like to say more efficient versus faster and cheaper because I'm the chief risk officer as well. Even though your chief compliance officer apparently doesn't think we're fun, I think I'm wildly fun. But I think as we lean further into that and the credentialization of the sector, that's a place where we're seeing a lot of uptick. One of the things we were really excited to announce is we are now settling with Visa in USDC. And the reason for that is being able to settle 24/7, 365, reduction of collateral requirements, that leads to more effective and efficient capital usage for businesses globally. And I think that's a real use case as you see more things like FX move on chain and things like that, where you can actually use those to manage your capital and liquidity positions on a global basis in a super efficient and effective manner.
Sanja?
Yeah, from an issuer perspective and the data we see, and like zooming out, we see three major macro use cases. And the first one is really dollar access. And from our data, we see that 1/4, like around 25% of USDC in circulation is actually held for dollar access store of value use cases, which is remarkable and close to my heart, because my personal story is that I was born in Sarajevo, Bosnia, and my family went through war, and we lost everything we had. So having the opportunity to give sovereignty of money, and just with an internet connection and with a wallet, having access to a dollar account, I think it's the primary use case for everything we do. The second use case, it's really payments and cross-border trade. And here we're talking about multiple use cases, from companies just managing internal treasury and moving money across different jurisdictions. And now they have the opportunity to do that with a stablecoin instantly, instead of like going through multiple corresponding banks, to companies paying their employees, paying their merchants with US settlements. Really in seconds, instead of waiting for days or even weeks to settle, to really peer-to-peer remittance within retail users. And then the third use case, which people really associate mostly with like speculative, I don't really see that in that way, but it's capital markets, and that's where we need 24/7 settlements, 24/7 liquidity availability. And really, this is where we see also stablecoin disrupting like the traditional TradFi capital markets by providing instant settlement and availability of 24/7 liquidity.
And you mentioned that the first bucket was 25%. The next two, what's the rough split?
Still not able to really associate a split. I think the majority is still held in like trading, but payments is growing. Like, what I can say is that after Genius Act, we saw acceleration of payments use cases of 70% growth month by month. So I can see that growing with regulation increasing. It's like trust is given by regulation and maturity of how companies can adopt this infrastructure.
Makes sense. Junaid, anything to add?
I'll take a little more specific view. We're an Africa-focused business, so I can tell you what we're seeing here rather than what's happening globally. For us, what we're seeing a lot of is internal treasury management for multinational corporations. That's one huge use case. Remittances are a huge topic, obviously, in all the African markets. It's one of the main sources of foreign currency in a lot of the markets and a big part of national income. So using stablecoin to remit is a key use case. Remittance industry is extremely competitive given the size of the remittance flows in the region. So, that's a lot about rates and, can you get better pricing if you do it over stablecoin versus fiat? So there's a real economic driver there from a remittance company perspective as well. There's also a lot of, I think what Sanja was saying around currency hedging that's needed from a business perspective, but also from a consumer perspective. In a lot of these markets, the currency can devaluate 20-30% easily in one, kind of market movement. And so people being able to have an alternative store of value is really important. And I think the backdrop for all of that is that this, a lot of the time, is not a nice to have in the markets that we're operating in. It's a must have because there is no alternative, right? If you're a consumer and you want a dollar-based account to hedge your local currency exposure in a lot of the markets we operate in, you just can't have one, right? So this is not a nice, it's a must. And same for businesses, if you're a local importer, you want a USD correspondent bank, you're definitely not going to get one, right? Even a lot of highly regulated PSPs, etc., can't have access to that. So that's a lot of what the problem that's being solved here is, and what the needs we see.
And in some of these markets where there's hyperinflation and people really want access to dollars, what's been the regulatory response you're seeing so far? Like, how do the local regulators in those markets feel about this alternative?
Yeah, it's erratic, right? And changes almost by the day or by the week. Probably the biggest challenge to, working on this problem in these markets is what will the regulator wake up thinking tomorrow, right? I think we're still in the phase where people are, let's fight it rather than, let's adopt it and accept the reality of the lack of the real alternative. So it's an everyday battle. In some markets, it's more regulated, more accepted. Like, South Africa's come out with a crypto asset service provider licensing regime, first market in the region to do that. I believe other markets will go the same way, but we're not quite there yet. So probably the biggest challenge now is continuity of bank support, regulatory support, etc., for the on-ramp and off-ramp in the local market.
Can I disagree with what you just said slightly? Sure. I told you I was going to be the one on the panel.
Yeah.
I think that this is an area where maybe the industry hasn't done a great service to itself, because as somebody who owns and manages a highly regulated institution, a big component of getting the regulators comfortable is education. When I first started working in digital assets, I'm pretty sure my family thought I worked for Bitcoin. And I was like, that's not a thing. Let me explain this to you. But we've done a bad job of using nomenclature and jargon versus, I remember our first banking exam post-acquisition when we were explaining this, and they're like, well, if you lose this, you lose your money. And I live in Manhattan. I was like, and if I leave my wallet on the 6 train going to work today, I'm not getting that back either. And those sort of narratives and the actual real world use cases, especially in the emerging markets, I think making the regulators an ally versus an albatross is the critical function that the industry needs to take on. Because I think even domestically in the US, for a long time it was, how can we avoid this? How can we almost live in the gray? And then, not correctly in my opinion, we had a number of regulation by enforcement scenarios, and now we're itching for clear and responsible guidance. And so I think that's a place where the engagement on a global basis by industry and by the banks needs to be more aligned in order to actually get to a framework that I think will be more sustainable and give, the FIs in the mix as well more comfort on what they can and can't do.
I don't think we disagree there.
Okay.
I think fully agree. We would love clearer guidelines about how these things can be done. I think the problem we face is erraticness of what are the guidelines. You can't really rely on a rail when the rules change every month.
You were reading the letter on your flight. On my flight back to New York, the OCC just released their notice of proposed rulemaking. So that'll be a lovely 320 pages on my flight back. But I think there's still a lot there that can be influenced as well, which is a great place to be for the credentialization of the rail and the long-term viability of the sector.
But can you drill down a little more on what you mean by how the industry can better engage with the regulators? Like, what are some examples of what the industry can be doing with the regulator?
I think historically, and I'll speak to the US market, I used to be appalled. I was like, don't tweet at Elon Musk. It's not a good regulatory engagement strategy. It doesn't credentialize the sector. What we're seeing now is we're seeing folks, and I was asking Chris before we took the stage, I'm like, are we going to get you in DC with us anytime soon? Going in, having those discussions, explaining the use cases around it, explaining how this is a viable, credentialed payment rail that can actually be used for more efficiency and is customer-centric versus, obtuse and things that aren't easily understandable. Explain the local worker in a congressman's district who can now, instead of paying exorbitant global remittances fees, do it in a safe, sound, fast, and efficient manner to get money home to his family. That resonates in a real-world use case versus sort of some of the abstractions. And I think, not saying that everything between traditional financial institutions and digital assets companies in the US as it relates to regulation is like a big love fest right now, but there's definitely been more alignment that this is the future, this is going to be a payment rail, so let's do it in a responsible way and let's explain the why behind a lot of these use cases. Just what we did up here, but bring it to a different audience.
Mm-hmm. And so we talked about what the industry can be doing, but what do you think the regulators can be doing differently? And what are they doing well and what are they not doing well today?
I think that you made a great point there. It can feel like regulatory whiplash. You can feel like you're doing everything to be compliant and do it in the right way and be the boy or girl scout approach of we're doing this above, and then the rules of the game change. And how do you cope with that and run and manage a business? How do you deal with a regulator who comes in and says, tomorrow you can't operate in this geo, and people are relying on it? It's really, really hard to do that. And so the regulators finding consistency and finding a bridge with industry on a global basis, I think is really necessary. Like we saw a lot of companies go offshore when there was no regulation in the US to just avoid the regulatory whiplash and the regulation by enforcement. So ensuring that there is a global framework that is at least moderately homogenous, I think is the best that we can do at this point.
I think I'd like to add something. I mean, something that they did do well, and you mentioned earlier, Bitcoin was down 40% over the last 6 months, stablecoin volume had doubled. It's when they bifurcated crypto assets and stablecoins and put legislation in specifically to regulate stablecoins to let it flourish as a payment rail and see these payments use cases, and crypto assets under a different regulatory regime. And I think that did a lot of good for the industry, specifically, adopted in EMEA, Genius followed, and I think taking that playbook into Africa, there's a playbook now for local African regulators to look at this and go like, let's actually separate this out and put some pragmatic regulation in place.
Yeah, I think to add on everything that was said, and I completely agree with every one of your points, if you look at that holistically, like today there's no harmonization, as you were saying, in different jurisdictions. So it's very difficult for a company and an issuer to be compliant in all the jurisdictions they need to operate in. And as Circle, we have always been compliance first. Like even when frameworks were not existing, we were there in every single country lobbying for a framework and like helping to build that framework. But we could only do so because we are Circle and we are as big as we are, and we have a huge policy team to help us get on the ground. And even if you look at MiCA, everyone thinks that it's this amazing framework in Europe, and I agree it is, but the rules are very stringent to comply and like be an issuer and to comply with MiCA. So that doesn't leave a lot of room for innovation for like smaller companies. So how do we solve for that? And I think, to your point, we need a better harmonization of rules internationally.
Makes sense. And maybe now if we start looking at the adoption, the other side of the adoption equation, where today do you think the traditional rails are actually better and therefore we haven't seen much adoption?
I think if you think about domestic payment schemes around the world, so you've got faster payments in the UK, you've got Pix in Brazil, you've got UPI in India. Those domestic instant payments have largely been solved, and those payment systems have been innovating at a pace over the last 5 to 10 years. The problem is they're all innovating at a different pace, and nothing really collects them together very well, besides the correspondent banking system and SWIFT. So if you want always on 24/7 instant payments, you need to solve the domestic instant payment rail, but then you need to connect them together. And I think stablecoins and blockchain infrastructure have done an amazing job at connecting these real-time payment rails around the world. And therefore creating an end-to-end, whether it's a fiat-to-fiat payment or it starts and ends in stablecoins, but giving access to real-time 24/7 payments. So I think that kind of bridging this gap of where arguably, we spoke about, if you're an African bank or a PSP, Junaid mentioned, try go get a correspondent banking relationship and get dollar access. It's basically impossible. Now they can do that, and they can do the same sort of flows from Nigeria to China. If you're an importer in Nigeria and paying an exporter in China, you can do that using blockchains that are connecting these payment systems today. So I think at that kind of macro level, they've done a really good job at connecting local innovation and happening in specific payments markets.
Yeah, I think the use case that is most ripe for development is just the consumer use case. The interoperability factor has been harder there from yes, if it's an emerging market and you're trying to hedge against inflation, like there's definitely a world there. But I think that's where, and we mentioned like the card products and things like that, that actually bring the ability to use those funds in a consumer use case into real world analysis. I think that's the place where there's probably the most white space in order to build and grow and innovate. Because I do think like the global remittance use case at some point, especially, and I know there's a panel on AI, so we're not really going to talk about it, but when you think about agentic payments and smart routing through whichever rail from a geography, from a use case, from a product perspective makes the most sense, you see a world where there's ACH, there's SWIFT, there's stablecoin rails, like all of those work together. So then how do you expand the aperture and the TAM to, you know, Erica, who wants to hold funds and be able to spend all around the world and figure out how she can actually do that?
I think whenever we have a hype, and now we are in a stablecoin hype, everyone is like, how can we use stablecoins everywhere? And I don't think that's the right approach, because if you're paying for your coffee in London or Milan or New York, that, you know, works quite well today. It's fast. There's consumer protection. So I think, you know, the real question is, how can we use stablecoins to disrupt the rails that are not working today? And for everyone here, if you've ever tried to send an international payment in emerging corridors, you know that it's fast, it's really costly. It can cost up to like 6-7% of the transaction itself. So you can disrupt there by giving, you know, a digital dollar or a digital euro that moves instantly from point to point. Now, also I think we like to think that everyone will be transacting on chain. And that's going to happen, but like there's the time in between. So how can we work like in the time in between is by providing on and off ramps and by using what we call like the stablecoin sandwich in between. So really helping companies, helping retail users to on-ramp in their local currency and then use a stablecoin dollar to transact that value anywhere in the world, and still giving them the opportunity to do the last mile and off-ramp if they need to go back into local currency.
So the friction is greater outside of the window of being an everyday currency. But do you think that long-term stablecoins has the potential to become an everyday currency, or do you think it's kind of not worth the industry focusing on that, given the pain point is so much greater cross-border?
I think so. Like what we're seeing, for example, in Europe, Europe is a very mature market because of MiCA, and as Circle, we work predominantly with companies and enterprises. Like we don't touch retail for our everyday uses. We do that through our partners. So what we're seeing is that, you know, when there is regulation in place and companies know how to treat the asset and like how to account for it, they will most likely adopt it for everyday transactions. And that's, you know, moving money across different jurisdictions for their own treasury movement, paying their suppliers, paying their employees. I think it's still going to be related to international and cross-border trade, not really domestic, because we have domestic rails in countries that work very well. But then when it comes to then interoperability, then we can use stablecoins to settle in between.
Any opposing view on whether it should be a domestic currency as well?
No opposing view, but maybe just to share some thoughts on like what I think could help with that aspect of it, because I mean, our business is 75% local acceptance and payout and 25% moving money cross-border. And now, over the last 3 years, we've moved 100% of our cross-border movement to stablecoin and about 0% of our local acceptance and payout to stablecoin. Why? To grow a payment method in the local market, you need to have kind of a virtuous cycle between adoption and acceptance, right? And merchant acceptance right now of stablecoin payments for local payment use cases, at least in the markets we operate in, is still on like day zero, essentially. We have a few merchants, you know, that are interested in experimenting with it, etc. We offer it as part of our checkout, etc. But you know, it's a tiny fraction of total volume processed, right? And I think traditional payment instruments have a lot of features built into them that are still missing to use stablecoin for acceptance. I mean, if you look at a credit card, yes, it's a payment instrument, but it's also token of what is your identity, a token of trust, a token of the ability to refund and charge back. You can get credit on it. So for consumer, that's something with high utility. Even in mobile money markets, mobile money wallets are starting to have some of these functions as well. Our business started in account-to-account payments. Account-to-account payments are also going that way. Until we start seeing those kinds of features on crypto as an acceptance or payment method locally, I think there'll still be a challenge in driving the merchant adoption side of it. That's what we see.
Chris, you were going to say something?
No, I think I was going to echo kind of what Junaid had mentioned, is that we are at the early innings of it, of you getting the flywheel of, there's definitely consumer adoption. You can look at any report and stablecoin volumes, number of stablecoins used. A lot of that is held by emerging market users that are using it for all the use cases we mentioned. But you're starting to see large enterprise merchants thinking about this, because if you're a global big tech and you're selling a digital product into 200 markets around the world. Today, you're stitching together a couple of different PSPs. A lot of the time, you're accepting in domestic currency, you're getting some capital trapped. If you can just accept stablecoin, you remove the FX exposure in your traditional business. So I think you are starting to see early adoption of specifically global merchants looking at stablecoin acceptance. And I think, as Junaid mentioned, you need a kind of critical mass of consumers, but crucially a critical mass of merchants who want to accept it for it to be, seen as another form of money being used every day.
And what are some of the other areas maybe that are holding back adoption today? Whether it's like technical, commercial, scalability, reliability, anything like that?
I do think credentialization of it, like in this room, everyone understands this. We're all speaking the same language. But there's a lot of rooms where this still feels like, although we have bifurcated between crypto and stablecoins, where it still does feel like these could be used for nefarious purposes. How do things, there aren't the protections that come with other payment rails that are already in place now because of the emerging technology. So there's a lot of people, and I think right now everyone's saying, well, what should my stablecoin strategy be? And I think there's a lot of people who are like, why do I need a stablecoin strategy? And I think that's completely acceptable for some use cases. I think it's where people just block it off, because at this point they're like, well, how do I know it's going to be there? And there's a lot of highly valued, fully pegged, fully reserved stablecoins out there. There's also a lot of other tokens and coins that are coming to the market that perhaps don't give us, the best posture, that people are investing in and using as highly speculative assets. And, we'll talk about prediction markets and things like that. It's a very different calculus to the average merchant, the average consumer. So I think that's a big aspect of why some people haven't leaned in fully.
I think it's different between retail and wholesale. So as we were saying, like 2 billion people in the world are either unbanked or underbanked. Now they have access to this digital dollar, and they can hold, they can hedge, but they cannot spend it in many places. So I think that's the part that's missing on retail. With regards to wholesale and enterprises and companies, it's mostly driven by clarity on how they can use stablecoins. And a lot of companies come to us and they're like, oh, I want to use stablecoins, but can you do everything for me? I don't want to touch it. I don't want to have it on my balance sheet. I don't want to move it. So if you can do everything for me, then I'm good to go. So I think it's like clarity around how to account for it, how to use it, so that corporations can feel more confident and have more trust in it.
Yeah. So both kind of a market education point of view. Yeah.
I do think, despite us, eating and breathing stablecoins every day, pretty much, it's still pretty complex, because when an enterprise comes to you and says, what should my stablecoin strategy be? Their questions are, what chain should it run on? Which one should I use? I see there's $200 issued stablecoins. What are gas fees? How do I account for that? So I think with our stack and our platform, we help obfuscate a lot of that complexity away. You can send any stablecoin on any chain, and gas fees are taken care of. So, and that orchestration layer, I think, is still got, has got a lot of value to obfuscate this complexity. But I think comes back to this education piece. Yes, there's pragmatic regulation in place. It's bifurcated stablecoins and crypto. Adoption is happening, but we need to remove more and more complexity, just like, arguably traditional PSPs remove the complexity of a card payment. It's super complex underneath the hood, but it just works seamlessly. And I think, we need to get to that point for the real, growth to come through.
Okay, should we move on to a little bit about what you guys are seeing in your various businesses in terms of geographic differences? Like, where is adoption greatest, where is it weakest, and why in different markets? Maybe starting with Circle, Sanja.
Yeah, I think different use cases in different geographies, right? So I think in emerging markets where there's high inflation, volatility, or like distrust in governments, that's mostly retail driven, and that's where we see a lot of retail users using digital dollar to buy, sell, hold, hedge their wealth, and maybe like for the first time have the opportunity to hold a digital dollar and to participate in global trade. Then, as I was saying before, like in more mature markets like Europe and now the US, it's predominantly TradFi driven, it's corporations coming to us, and now again there's this hype of everyone wanting to launch their own stablecoin. All of these banks joining like consortiums in Europe, but then if you look at what that entails for a company to launch and maintain a stablecoin, then it makes more sense to work with a company like Circle because of predominantly three main things. One is like the liquidity that we already have. So today we have more than 75 billion of USDC in circulation. That's not something you can replicate in a day if you go and launch your own stablecoin. Two, it's really like the network effects that we create by having more than 10,000 partners, the exchanges, the liquidity, the banks we're integrated with. And the third element is really the trust, the reserves, like the transparency that we hold ourselves to. So that's very difficult to replicate, and that's why I think there is this hype of like everyone looking into having their own stablecoin, launching, joining consortiums. Which is also healthy in the short term because it shows that we are in the right industry and everyone wants to innovate. But I think what we'll see in the end, it's like a consolidation into having a few players who are able to scale.
I would agree with that 1,000%. I think the proliferation of everyone wanting a token and a different chain and everything like that, there will be a flight to quality, and the reserve rationale, I think, is massive because that gives you trust and confidence that there's actually currency standing behind the coin. So I think that's going to be a huge differentiator. I also think Latin America is a place we've seen a ton of adoption, both on the commercial and retail sector. And that comes from just the need for these types of products. And so I think a lot of the adoption is just need-driven based on what's going on in the local currencies and people's openness to innovation and finding a new path forward.
Yeah. I think we recently commissioned the stablecoin utility report. You guys will see the QR code, so if you a bit of a plug for the report on the tables there. But we actually did the kind of research because you'd see the on-chain transaction research. You'd see stablecoin issuance going through the roof, these sorts of things. But we went out and did a large survey of about 4,500 users across 15 countries, mainly emerging markets, just asking them how they're using stablecoin every day, and that's what it's called the stablecoin utility report. And in that, you find that, look, stablecoins have been adopted, there's a lot of that, but there's this access gap between, we asked them, 77% of respondents said, look, they would use stablecoin as if it was offered by their traditional fintech or bank. So there is this trust element that, look, we want to use this, but I'd just as easily use it through my local fintech application or my local bank, but they just don't have access to do that. So I think, we're seeing users adopt, but merchants and banks and financial institutions need to catch up. And once we have that, you're going to see an explosion of additional use cases on top, in different geographies as well.
Yeah, if I think about the countries that we operate in, there's a few factors that need to be there where we see adoption versus we don't see adoption. I would say some of those factors are how prevalent are those use cases we were talking about? How much is their remittance in that market? How much is there multinational corporations that have significant operations locally that might need to do rebalancing of treasury, etc.? So you got to have that demand side of it, and that's not true in every African market. It's maybe true in 10 to 15 African markets where this demand side actually exists. Then the market can have like a few things that, few market failures that I think then drive the adoption of stablecoin. One market failure is definitely volatility of currency linked to volatility of inflation, but that's not a necessary condition because like one example I think that stands out for me is Francophone West Africa. I mean, it's a euro-pegged monetary union mostly, but there's still massive adoption, and it's not because the currency is volatile, currency is stable. Inflation is stable. There, for example, the market failure is rather lack of access to dollar liquidity and intransparency in how the dollar liquidity that exists in the market is distributed amongst market participants. Is it transparent? Is it fair? Do you have a fair shot, or does it go, to the friends of the bank, essentially, right? And that's kind of like another one that I think drives a lot of it. So that's kind of like the framework that we use to prioritize markets, and what it means is it's not always the biggest markets where these things have the most adoption. Actually, sometimes it's the smaller markets where it's more needed because the local banking system is less functional, and their adoption becomes essential.
Today there are many different constituents in the market. You've got issuers, you've got infrastructure providers, application providers, traditional incumbents who are getting into the space. Who, in your guys' view, is best positioned to win in this space, and why?
I think the market can get big enough for all of these different layers of the stack to build really meaningful businesses. If you think about traditional payments, there's many participants in there, and many of them have built significant businesses. I think you need all of these market participants for a thriving, I guess, stablecoin economy. And you need that retail application, you need that banking application to put that in the hands of the customer. How are they going to do that? They're going to use an infrastructure provider like BVNK to actually give them access. Okay, but we use issuers like Circle to get USDC as the major stablecoin. So I think you need every layer of the stack. Some strategies are to go full stack. I think a better strategy is to you can't be everything to everyone, and you need to do what you're good at, know where you're good at, and partner in other areas. So I think there's enough TPV to go around, I would say.
Yeah, I would agree with that 100%, to be honest. I think that it's the quintessential build, buy, or partner. And so there's going to be different permutations as the sector evolves. I do think the one sort of open issuance on tokens is the one that I'm not sure that I fully understand all these. Like, is everyone going to have a closed loop token for themselves? Is that really going to drive a broader adoption? Will they stick? Will they all fail? I think that's the one place where we'll see really clear winners and losers from an issuance side. But outside of that, I think that the ecosystem can support everyone to sort of come together to create whatever framework works best for the actual customer.
I agree. I think today there's a lot of fragmentation as well. So let's say you're a company and you want to move money with stablecoins. You have to work with an issuer, then you have a custodian, then you might have someone providing you a license. So there's a lot of fragmentation of working with multiple partners. I think the winners in the long term are going to be the companies and the providers that are able to provide a full stack financial technology platform. So at Circle, we're going through a change of strategy because I think we're very well known for providing USDC and EURC, so as the issuer of tokenized money. We also have a money market fund. But now it's really moving into how can we provide the infrastructure and the rails for people to move that money. So we started doing that through something called the Circle Payment Network, which is a two-sided market where we match companies with institutions like taking their money and then moving that money and on off-ramping in emerging markets. And then really now building that operating system on Arc, which is our layer 1 blockchain that we launched in testnet with more than 100 partners, coming into mainnet in June. And really what we're seeing when we speak with the enterprises is, if you think about moving money on Ethereum today, like a company doesn't want to have that complexity, as you were saying, of like, that it's congested and so I have to pay higher gas fees. Like that doesn't mean anything to me as a company. So therefore, we are launching our own blockchain Arc, which is going to be priced in dollars, in USDC. So there's no volatility of the currency, has elements of opt-in privacy. So we think that in the end, the platforms that will win in the futures are the ones that are able to combine all of these elements together.
I mean, anytime there's a change in market structure, adoption of a new technology, I think it's inevitable there'll be a value transfer. And I think the value transfer is always from the incumbents to the new entrants, right? And yes, there'll be enough for everyone to go around, but I think it's an opportunity to create new financial institutions, new incumbents, etc., on stablecoin native, right? And I think that's what's playing out now.
If you actually look over the arc of different technology innovations, generally the ratio is 60-40. So 60% of the value capture actually goes to incumbents and 40% goes to the new players.
Interesting.
Oh. Great. I think we only have 9 minutes left, so I'm going to move to some of the audience questions which have come through. The one with the most upvotes so far. So if stablecoins become the primary B2B settlement layer, but remain niche for consumer spend, is that success or failure for the original vision? Chris, you want to start?
I think it would be success. I mean, if you go back all the way to the Bitcoin white paper and you read what Satoshi wrote, it was a peer-to-peer electronic cash. It was a payment system, effectively. So if you have moved significant value onto, blockchains that are now, acting as a global settlement and payment system, I think that's success. Does that mean the consumers are not getting the benefit of stablecoins at scale? Probably in that world, but I don't think it plays out like that. I think it actually serves both purposes. As I mentioned earlier, it can be that settlement layer and that payment method, as well as infrastructure to build new financial products on top of.
I agree. Like even if you read the Bitcoin white paper, like the original idea is to solve for a fundamental existing problem. So if we're able to disintermediate corresponding banks, if we're able to lower the costs and make a payment efficient, whether that's B2B or peer-to-peer, I think we're winning.
Success.
I don't know, to be honest. I think it's a really good question because it's both, to be honest. I think it wouldn't harness the full value of the technology, and that would be disappointing. But I still think that's okay if that's where the market drives it, but I think it would be a disappointment.
Yeah, from my perspective, it's like, I don't think it's reasonable to expect that there'll be one payment method for everything. I mean, even if you look at the financial system today, local payment methods are card, account-to-account, wallets, mobile money, whatever. That's good for local acceptance and money movement, right? But foreign payments are SWIFT. They're bulk, wholesale, rails, etc., which are not suitable for local consumer payments, right? They're optimized for a different thing. So maybe we can optimize, for many things at the same time, but I don't think it's ever going to be just one answer, and I don't think that can be a reasonable measure of success.
Okay, the next one is for Erica. What criteria is Lead Bank using to sponsor stablecoin issuers? How do you enable the mid-market to be able to compete with the big whales?
So I was telling this story earlier. When we acquired Lead in August of 22, for the purpose of facilitating digital assets, I think a lot of people thought we were nuts. I think we have always taken the position that it's not the size of the company, it's the caliber of the team and what they're building and their commitment to compliance. So we have taken the approach that, of course, when our friends at Circle and BVNK show up, we're very grateful and happy to work with both of you, but we have to take the bets on the earlier stage companies as well. So as long as we believe in the team that's behind it, there's a commitment to compliance, because at the end of my day, I run an anti-network effects business, and every incremental client that I bring onto my platform and Rails increases the risk profile for my other clients, and I take that incredibly seriously. And one bad actor, especially in the US, in a market where a lot of politicians are looking for something really bad to happen, to have the clickbait and go on the news and talk about it, we have to be very choosy about the credentialization of the partners that we're taking on. But if there's an understanding of that and a management of the risk profile, we're very open to take on earlier stage companies and look into emerging markets. And so I think we've had a really great success in being early entrants and supporting companies that were at a very early part in the stablecoin arc.
Okay, next question. To Junaid's point about identity playing a big role in merchant adoption, is there a push to incorporate identity into stablecoin go-to-market strategy? Anyone?
I mean, I would love that. I think tokenized identity is such a, like, it's just something that makes a ton of sense. Like, also when you look at the fundamentals of sort of identity and for fraud loss and things like that, in this world of deepfakes and AI, identity is like the worst thing to use to actually like combat real fraud. And you're looking at sort of the other metrics, the transaction monitoring, things like that. But I think it would make a ton of sense. I don't know the exact way to do it, and I would leave that to y'all on stage, but I think it could be really interesting.
So where we're seeing merchants be more comfortable with this aspect of it is where the issuer takes responsibility for identity. Maybe it's not issuer in the sense of you issued the coin, but you're the issuer of the wallet that the coin lives in, right? And for example, in our crypto acceptance product, it only accepts crypto acceptance from closed loop wallets, which are KYC'd, for example, not open loop wallets where identity is anonymous. And most of our merchants are big on that because otherwise, there's no way they can answer questions about where the money went when a payment got made, right? So I think there's a big role for the wallets and the issuers to play there. And I mean, ultimately, the card issuing banks and card networks have played that role in the fiat world. There needs to be a new owner of that. And I think consumer wallets and currency issuers are really well placed to do it.
I think there's been a regulatory push to push identity into payments with travel rule implementation across stablecoin payments and that sort of thing. And I agree with Junaid where some of the merchants that we speak to and the payment companies, they want to know who's sending them that money, whether it's a regulatory obligation. And even if it wasn't, they would say, hey, I actually don't want to receive any funds from an unhosted wallet or self-custodial wallet. Can you solve that from a technology standpoint to only receive from hosted wallets? So I think identity is crucially important and needs to, and that data is starting to travel with the payment. But there's probably more elegant solutions where you build it into the chain itself, which I know there's some privacy features happening across some of the layer ones. So I think it's a problem. There's probably many solutions to this kind of identity moving with a problem. Today the UX is a bit clunky, but I think it probably only gets better.
Yeah, I think the reason why I was hesitant and thinking about it is I got asked this question I think 8 years ago on a similar panel, and thinking about where we are now, still a lot of identity processes are very manual. And it makes total sense that we tokenize identity and we move it on chain. I just think it's gonna take some time to get there. So don't have a really smart answer to that.
Okay, and the next one, the governor of the South African Reserve Bank mentioned last week that stablecoins will break, a clear signal of distrust. How do we as an industry respond?
Junaid's teed up for that one.
I think I'm least teed up to comment on that one. Keen to hear what you guys think.
Look, I think central bankers and regulators have long been skeptical, and to the conversation we had earlier, it's about education, it's about showing merchant adoption, it's about showing user adoption, and the problems these things can solve. And maybe he just needs to have a workshop with some of the guys from BVNK, and we can sort it out.
Yeah, education takes a lot of time. And I think in every jurisdiction that we are present, it has taken us months, if not years, to be able to educate the regulators, educate the merchant. It takes time. And also many people are still not exposed to what Web3 is.
So there's a lot of skepticism, but then in fact, if you bring them the use cases, if you explain how it works, they're going to feel more comfortable.
I think at this point it's almost more dangerous for the central banks to not investigate. Like, this isn't a technology that's going away, and we're seeing, what was it, the stablecoin summer was the quote you threw out there. Like, that's a dangerous position for that regulator to be in, to not be open to it, because then, one, it reduces innovation in your local market, and two, it hurts your customer base.
The one thing I will say is the South African Reserve Bank has been forward on crypto and stablecoin versus any other regulator in the region. They have a licensing framework. They've issued many licenses. It's well documented. There's good compliance around it. So I'm not sure where that comment comes from, but I don't think it's in line with the trend that we're seeing from a regulatory perspective locally.
Great. I think that's all we have time for, but please put your hands together for the panelists. Thank you.